Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. In today's video, we are going to be continuing our conversation about the similarities of some retail methods of analysis to Wyckoff and smart money concepts. Previously, we have spoken about head and shoulder formations and how they can actually be used as a form of break of structure or as a form of identifying market structure within institutional trading as a big umbrella term. We also spoke about break and retest, which is a strategy that is used by a lot of traders around the world, and the similarities of break and retest to what we do in terms of institutional candles or imbalances. And in today's video, we are now going to be speaking about divergence, which I have briefly spoken about in one of the Wyckoff introduction videos. However, I didn't go into too much detail about it, so this is going to be the video where I'll elaborate a little bit more about how you use divergence, how you use it alongside the indicators, and if we can use similar concepts within our analysis. But before I load up the slides and before we have a look at the charts, it's always important to understand why we even need to know these things. I mentioned this in the previous two videos as well, but the major reason why I'm recording these mini series is simply to make everyone understand that the methodologies that you have learned so far in the quote-unquote retail methods of analysis is not far from these institutional concepts, and is simply looking at the same pattern, looking at the same chart from a slightly different angle. And when you put these next to each other, hopefully it would give you a much better understanding of the institutional concepts and how you can actually get better at your entries and your risk to rewards, and more importantly, the consistency of your winning rate. So firstly, let's have a conversation about what divergence actually is, how we use it alongside the indicators or oscillators, and have a look at a few chart examples as well. So first things first, when I mention oscillators, I simply mean indicators that appear at the bottom of your trading screen. For example, your MACD, your RSI, everything that in a way appears at the bottom over here. But not only that, indicators that are in a way oscillating between two zones. For example, if I go ahead and put RSI on my screen right now, you can always see that relative strength index, this indicator, is always oscillating between the 100 point and the 0 point. Mostly it's in between 80 and 20, but it's always oscillating in between these 2 points. It's always going up and down within those two different points. So when it comes to using divergence, especially alongside more retail methods of analysis, we use them alongside our oscillators. And you can, to be honest, use a lot of different oscillators, but we majorly use relative strength index or RSI, stochastic, or MACD. And MACD was my favorite indicator to always identify divergence on. It quite literally stands for moving average convergence divergence. And as mentioned previously, oscillators are these indicators that appear at the bottom of your screen. That's your RSI, stochastic, MACD, all of these indicators. You've probably come across them before, and most likely at the start of your trading journey, you were actually using them to analyze the charts. I know I was when I started my trading journey, but not anymore. So now that we have an idea of the different indicators or oscillators you can use to identify divergence, let's have a better understanding of exactly what divergence is. Now, whenever we speak about an indicator, it's in the word, it's indicating something, it's potentially indicating what's happening in the near future. However, all the indicators are actually meant to follow what the price does. So if price creates a new high, oftentimes indicators would follow. If the price creates a new low, oftentimes the indicators would follow. However, from time to time, you would be able to see that the price is actually creating a new high. However, at the same 2 points, when you look at your oscillators, whether they be MACD or RSI or whatever, you would be able to see that at the similar 2 points, I'm not going to say at the exact 2 points, but around the same areas, the indicator is creating a new low. So you can clearly see that the market has created a new high. However, your oscillators created a new low. This has always been a confirmation to sell this to the downside. So this has always been a bearish confirmation. And as a little definition, that's what we have up there. When the market creates higher highs, so in a way when the market creates a new high, but your oscillator creates lower lows. So at the same 2 points, your oscillator is actually creating a new low. I made this PowerPoint quite some time ago, but I think it's still good to actually visit it and study it. And these are some points and things to remember when it comes to divergence. So as I mentioned, divergence divergence points to a potential sell, you have to make sure that when the market is diverging, you draw the lines to indicate divergence on the top of the candles and on the top of your oscillator. So as you can see over here, the line to indicate divergence was drawn, as you can see, on the top of the candles, connecting the highs of the candles, these areas, and also on the top of these oscillators of this MACD. Not only that, you can use any of the mentioned three oscillators, but MACD and RSI is used more often. MACD and RSI are two indicators that people who trade divergence tend to pay a little bit more attention to compared with stochastics. However, we never would execute a trade just based on divergence, and this is where people go wrong, because they would just see a divergence and they would expect instant reversals there and then. Divergence is a confirmation, not a reasoning for the market to, either go up or down. So we always have to use divergence alongside different methods of analysis depending on your strategy. It might be candlestick formations, it might be support and resistance zone or Fibonacci levels or whatever it may be. And you can also use divergence on any given time frame. However, it is mostly used around the H4 to the M15, so we don't end up identifying too big of a divergence on daily or weekly, or too small of a divergence, which would only result in very small moves on the, for example, 1 minute or 3 minute time frames. Now, there is the opposite of divergence as well. We still call this divergence, but for the purposes of this training, I'm just going to label that as convergence, just to make it a little bit easier to distinguish between them. This is simply the opposite of divergence. So instead of the market creating a new high and the oscillator creating a new low, this is where the market creates a new low and the oscillator creates a new high. So in a way, as you can see, the market has created a new low. It's gone lower. However, our oscillator has created a new high. The MACD within the same two areas has actually created a new high. As you can imagine, opposite to divergence, where we would draw the lines on the top of the candles and on the top of the indicator, within convergence, or whenever we are expecting it to point towards a buy position, we would be drawing the lines to indicate convergence at the bottom of the candles, so connecting the bottom of these candles together, and at the bottom of the oscillator as well. And these lines should now be converging towards each other rather than diverging away from each other. And opposite to divergence, a convergence would actually point towards a potential buy in the market. However, there are things to remember when it comes to convergence as well, so let's go through them. Convergence points to a potential buy in the market. Make sure to draw the lines to indicate convergence at the bottom of the candles and at the bottom of your oscillator. So it's pretty self-explanatory, right? It's the complete opposite of divergence. Divergence, the lines are at the top of the candles and at the top of the oscillator, and they're diverging away from each other. And within a convergence, they're at the bottom of the candles and at the bottom of the oscillator, and they're converging towards each other. As mentioned before, you can use any of the mentioned three oscillators, but I personally have used MACD a little bit more to identify divergence. And do not execute only based on these concepts. You have to have other confirmations. So that's the general understanding of what divergence or convergence could be and how we can actually use it within our chart analysis. Now let's have a quick look at the actual charts to be able to see them live in action, and then what we'll do is we'll speak about the issues about convergence and divergence and why I don't use them anymore. So there are a couple examples, a very quick examples I'll give just so you can actually see them on the charts. An example of divergence would be over here where the market has created new highs. You can clearly see that the market is going higher and higher and higher. However, your oscillator is not following. Your oscillator is creating new lows. And I've drawn the lines on the top of the candles and on the top of the oscillator. They are indeed diverging away from each other, which resulted in this bearish move to the downside. Not just this, let's have a look at an example of a convergence as well. Again, we also call this divergence, but for the purposes of this training, I'm just saying convergence. An example of convergence would be, for example, over here. You can see that the market has created a new low. I'm drawing the lines at the bottom of the candles in this case, and on the bottom of the oscillator, you can see that it's created a new high. So these lines are now converging towards each other, which points to a potential buy, which resulted in the rally that took place after that. However, that's quite easy to go ahead and identify now that it's all taken place. When you see these live and you want to take trades based on them, everything would change. So I've highlighted a few examples over here to go through them, and then later on obviously we'll speak about the similarities of divergence to institutional concepts and how we can make it a little bit more accurate. The first example that I want to have a look at is this 15-minute potential convergence scenario, where you can see that if you were looking at this live, the first time you would be able to identify an element of convergence or divergence, whatever you want to call it, would have been from this low to this low. That would be the first place that you'd be able to identify this, and you can see that the market has created a new low. At the same 2 points, our MACD has created a new high. By the way, I'm using the actual lines to identify the convergence or divergence. Some people would use the histograms, but this is normal MACD with normal settings. It doesn't really matter. It all points towards the same thing anyway. So that would have been the first point, and if you saw this live, you might have actually expected reversals to take place there and then. So maybe based on other factors, you would have been looking to buy this to the upside. And, after that, you would have been manipulated out of your positions because this ended up actually creating another low after that. Let me take this off replay mode just to make it a little bit easier. And this is what took place in a way after that first scenario, where instead of this continuing to go higher, it actually ended up creating another low in the market. And you may have told yourself, okay, do you know what? This is actually still converging. This is still creating a new low. However, my oscillator is still not following. The market created another new low. My oscillator created a new high in this specific scenario. Again, over here, maybe you would have been expecting for this market to then go higher, and you would have been happy to see this first element of reversal over here, but you probably would have expected a little bit of a higher move. And once you started to see this reversal, now you would be worried and eventually you'd be taken out of your trade. So again, trading it based on that convergence alone would not have been enough. It happened one more time after that where the market created another new low. However, over here, as you can see, it didn't actually follow. It created a new high on the oscillator again. Again, you would have been expecting a bullish move over here. And this probably would have been the only and the final scenario that you would have actually been able to make some money off. You would have consolidated for a while, but if you held your positions, then obviously you would have seen some returns. So it's not accurate enough for me to want to now trust my analysis just based on this, to take 2 wrong trades based on what I see and then win 1. I don't mind doing that when it comes to higher risk to reward trades. If I'm looking at constant 1 to 50s, I really don't mind losing 15 times in a row and winning 1 trade. Normally that would never actually happen, but when it comes to these concepts, when I'm not even looking at higher risk to rewards, then I don't really want to keep losing and just win here and there based on absolute luck. The other point would be, where would I have actually entered based on this divergence or convergence? It would have been difficult to find out exactly where would we enter. Now, that's one of the examples that I wanted to show. This is the second example, where in this case, that's an example of a convergence that did play out. However, I want to actually go into a little bit more detail about this as well, because technically speaking, this wick to the downside could have actually manipulated people if they would have had their stop losses at this low, which is how a lot of people would have been trading this anyway. And it would have been a little bit of a hit and miss to just trade this based on this convergence. We can have a look at a couple more scenarios as well. This is another convergence scenario over here where the market has created a new low. At the same 2 points, you can see that your oscillator is creating a new high. Again, you probably would have been expecting to buy it around here. You would have been happy that it would have been in profit, and then boom, straight reversal after that. Either break-even scenarios or your stop losses would have been hit just before the market made the next move higher. This happens over and over and over again, and it's so easy to identify them when the move has happened, but I want you to see that when you would have been looking at this scenario, for example, live, everything would have been different, because if you were looking at this live, let me put this in replay mode again. If you were looking at this live, you wouldn't have been able to see what's happening after, and this would have been the exact convergence that you would have gone ahead and identified over there. And you would have expected the rally to continue, and that just did not happen. This market ended up actually dropping lower, and that would have been another losing scenario based on this convergence. This market ended up having a small rally and then coming back down again, break even, or stop losses would have been hit over there. Not only that, before it had the next rally, it didn't actually ended up converging at all. So from that low to this low, if I go ahead and identify those same areas, this is not converging anymore. The lines are not converging towards each other anymore. They're both going down. They're both going the same direction. However, this still ended up having this rally higher. Let's have a look at a few divergence examples as well. I'll come back to this convergence example. I'm going to keep this to explain this from an institutional perspective. But let's have a look at this example where we spoke about earlier. This is another one of the examples of divergence where it wouldn't have played out if you were looking at this live. You would have ended up losing quite a few trades before actually catching the move to the downside. So let's have a look at this, let's say on the 5-minute time frame. Again, remember the markets are fractal. So if I'm showing this to you on the 5 minute, it still would work on the hourly or 4-hour or whatever time frame you want to look at. Firstly, this would have been the first divergence that you would have identified from this high to this high. The market has clearly created a new high. However, your MACD has not followed. It's created a new low. See that I'm drawing the lines on the top of the candles and at the top of the oscillator now. So you would have expected certain sell positions to kick in at that high, and you would have been happy to see this reversal to the downside. However, again, after that, you would have either had break-even scenarios or stop-loss scenarios. And that happened one more time, where in a way you were able to see the market creating another new high from this high to the next one. Oops, right over there. The market has clearly created a new high. However, your oscillator has not followed. It's created a new low again. And over there, you would have been again happy because it went in profit, but eventually this reversed again, and that probably would have been break even or another stop loss scenario. That happened one more time from this high to the next one. You can see the market is creating a new high within the market. This is quite flat. This could be equal highs, but this is actually still identified as a divergence. So the market has in a way stayed at the same level or created a new high. However, your oscillator has not followed. These lines are still diverging away from each other, and maybe you would have been happy with the profits, and then boom, your stop loss would have been hit after that. Maybe you were looking at higher time frames, maybe 15-minute or for example the hourly that we were looking at a little bit earlier. And let's have a look at the hourly scenario right over there. So maybe you were looking at this, for example, on the hourly time frame, and you would have seen this move to the upside over there and this move to the downside over here. In these scenarios, you would have been able to capitalize off of these sells a little bit easier. However, even then, after that, we still ended up reversing and going the opposite way. So just trading based on divergence and convergence, hopefully now you can see that it's not enough. And it would be quite confusing to find out exactly where we would have entered. But now let's speak about the similarities of divergence and convergence to more institutional methods of analysis. So we speak a lot about Wyckoff on this channel, and that's exactly what I want to break down right now. You should all have seen a lot of the distribution and accumulation examples that we've posted, so I'm not going to do a Wyckoff training right now. We've got a whole 3-video series for Wyckoff which you can go and watch in your own time, and a lot of charts breakdowns for a better understanding. But generally speaking, the distribution looks something like this. Your preliminary supply, buy-in climax to this sign of weakness, up thrust, and then up thrust after distribution, where after some type of a break of structure, you'd expect a last point of supply to be created, and then you would trade that to the downside. Within this choppiness in the market, within this area that the market is in a way consolidating or being a little bit choppy going higher, this is actually where your divergence would get created, because this is the area that the market is creating new highs. However, oftentimes your oscillator wouldn't follow, and within the same area, your oscillator would end up creating a new low. The example of convergence would be for an accumulation, where you have your preliminary support, selling climax, automatic rally, and then this secondary test in phase B, and the spring, where again you'd expect a breaker structure, last point of support, and then trade this to the upside. And this is again the same thing. Within this choppiness, within this area of consolidation, the market ends up creating new lows. However, your oscillator oftentimes wouldn't follow. Your oscillator would create new highs. And I want to have a look at the same examples we just looked at, but this time from a little bit more factual perspective, and look at it in terms of Wyckoff. You've probably seen these breakdowns before, but in a way, in this first example, instead of continuously identifying these as going to the lower point and creating new lows and try and trade this based on divergence or convergence, we can actually go ahead and label this as Wyckoff and trade based on some type of a breaker structure to the upside. So this could very easily be your preliminary support, selling climax to this automatic rally, secondary test in phase B, or another element of secondary test, and the final spring which created the low of that range. And after that, these are your minor breaks of structure to the upside. So you could have actually taken your trades over here based on previous institutional candles, or you could have been waiting for a more major break of structure to the upside and then take the trade based on the pullback and some type of an imbalance or an institutional candle. So when you look at it from the perspective of Wyckoff, it's a lot more factual rather than just seeing the market create a new high and the oscillator creating a new low, or vice versa, market creating a new low and the oscillator creating a new high. I'm going to show a few more examples as well. Let's have a look at this second accumulation example over here. And let's go to the 5 minutes in this case, just so we can see this a little bit clearer. So that was the example of another convergence that we were speaking about. However, you can actually label this as a Wyckoff schematic. This could be your selling climax to this sign of strength or automatic rally back up. It doesn't really matter. Your secondary test in phase B and the final spring to the downside, minor breaks of structure and the more major breaks of structure to the upside. So it's the same area, it's the same directional bias, but it's a little bit more factual because now we are analyzing it from the perspective of Wyckoff, and the entries would come based on smart money concepts, institutional candle imbalances and all of these things. So let's have a look at a few more examples as well. I said that I'm going to be breaking down this example in terms of Wyckoff rather than necessarily divergence, but it's the same example, it's the same scenario. We've created a new low, the oscillator has created a new high, and we still ended up going lower. It created a new low, oscillator created a new high, and the question would be exactly where would you have looked to enter it? Whereas from the perspective of Wyckoff, you can look at this as your selling climax, and this as your secondary test in phase B, and this as your spring. I just skipped a lot of the markups in the middle because we should all know the markups by now anyway. So selling climax, secondary test in phase B, and the spring. Again, these could be very minor breaks of structure to the upside, but more so these would be the more major breaks of structure, or up here would be the more major breaks of structure, and your last points of support being created before you have the next rally higher. This is an example of a distribution, which we identified it earlier from the perspective of divergence. So instead of looking at this from the perspective of divergence, now I want to have a look at this from the perspective of distribution. You can go ahead and label this as your preliminary supply, buying climax to sign of weakness. These could be up thrusts to the upside, and then this is now your up thrust after distribution, the high of that range. Breaks of the minor structure points to the upside and more major breaks of structure to the downside. And then you'd be able to capitalize off of this shorter move to the downside. You might say, hang on a second, Mehdi, this still reversed and ended up going higher. This is where I'm going to remind you of the previous videos in regards to Wyckoff and what we have spoken about. This is just an example of a minor distribution. We wouldn't actually end up taking a trade based on this distribution simply for one reason. The entire previous structure was completely bullish. We've been continuously creating higher lows and higher highs, higher highs and higher lows and higher highs and higher lows and higher highs. So we wouldn't even be looking at distributions around there or around here to sell it down. I just wanted you to have a better understanding of what it can look like in terms of distribution and divergence. So for those of you who have been studying Wyckoff a little bit more, and for those of you who have watched the 3 videos that I've posted in regards to Wyckoff introduction, now you can see the similarities of Wyckoff to divergence, and you can see that they're not far from each other, but Wyckoff, distribution and accumulation, is just a slightly better way of analyzing charts instead of looking at convergence or divergence. But as mentioned, we never would take a trade just based on those. I literally released a video a few days ago about top-down analysis, and in that video I clearly said that we would never just trade based on Wyckoff. We would be taking trades based on other factors. We have to see market structure and many different things before we decide to go ahead and execute any trades. So all of that still stands. Just because you see Wyckoff distribution or accumulation or some type of a divergence or convergence doesn't mean you should go ahead and enter the trade there and then. Now, I'm going to speak also about a slightly different type of divergence as well. This is where we would use divergence in between currency pairs. So instead of identifying divergence, for example, on one currency pair and an indicator, we would want to identify divergence between 2 different currency pairs that are meant to be going the same way. I'll speak about this very briefly, but I'm not going to give too much information about it for one specific reason. I do not use this for my analysis. So the example that I'll give would be Australian dollar versus US dollar and New Zealand dollar versus US dollar, so AUD USD and NZD USD. Now, I always say don't correlate pairs when you're analyzing the charts, and I stand by that. Whenever you're analyzing a chart, don't correlate pairs. However, certain currency pairs are meant to be going the same direction, such as AUD USD and NZD USD. Oftentimes, they follow the same trend and they go within the same direction simply because they're both US dollar currency pairs, and Australian dollar and New Zealand dollar, and Australia and New Zealand in general, they have very similar economies, and everything is very connected with each other. Hence, we would expect them to go the same way. So what I'm going to do is I'm just going to add NZD USD to the chart right now. So let's go ahead and do that. And also what I want to do is I want to change that from a line to candles. So the green and red candles are NZD USD. You can see the green and red candles. These are NZD USD, and we are looking at that next to AUD USD. You can see generally they are following the same direction. When one creates a new high, the other one follows. One creates a new low, the other one follows, and so on and so forth. However, sometimes it so happens that AUD USD, for example, would create a new high. However, NZD USD wouldn't necessarily follow, or vice versa. NZD USD would create a new high and AUD USD wouldn't follow. You can almost see it here where AUD USD has created a new low. However, within the same areas, NZD USD has created a new high. So sometimes they're not going to be following the same direction. And the reason I'm speaking about this, and I'll speak about this briefly, is simply because you can actually use divergence in between a couple different currency pairs. When I first learned about it, I was very excited about it, and I was looking at the charts and analyzing them, using it. But over time, I started to realize that if you end up basing your analysis on simple convergence and divergence in between two different currency pairs, you would actually end up ignoring the important data, such as the market structure, such as higher time frame points of interest, such as everything that I spoke about in the top-down analysis video. And it wouldn't necessarily be a good idea just because AUD USD is going up and NZD USD going down to base all of your trades on that. There are much better factors and much better methodologies that you would be able to use, which are the methodologies that you have been seeing in all the previous videos. So to conclude, divergence is indeed a good way of looking at the charts and the markets. However, it's incomplete because it's not as accurate as we would like it to be. Divergence is very, very, very similar to Wyckoff schematics. So the Wyckoff distribution that we look at is an example of a divergence, and a Wyckoff accumulation is an example of a convergence. They're all the same thing. But instead of looking at the charts from a divergence or convergence perspective, if you start to look at it from a Wyckoff perspective and the market structure perspective, then your trades would be much more confirmed. For example, as you have identified an element of a bullish trend, and now, for example, you want to look to buy it somewhere around here, instead of looking at this as potential convergence coming in and then expecting this to go higher, what you can actually do is you can start to see if we are about to form elements of a Wyckoff accumulation and a break of structure, and that's still going to be the same thing. It's still going to be that convergence, and you would be able to take your trades based on Wyckoff accumulation instead of divergence or convergence. In a bearish trend, for example, it would be the same thing. It would be a Wyckoff distribution maybe that you would want to be keeping an eye on, and then taking trades based on this distribution rather than necessarily taking the trades based on divergence in this case. So for those of you who've traded convergence and divergence in the past, and for those of you who are trying to get a better understanding of Wyckoff, you can now start to mix these two to get your eyes used to seeing Wyckoff schematics at different parts on your charts. And little by little, you'll make the transition to completely use Wyckoff instead of divergence the same way I have. And hopefully this would be a much smoother way for you to get a much better understanding of these concepts and how we use them for our analysis. But with that being said, I hope you got value from this video. If you did, make sure to press the like button down below and subscribe to the channel if you are new. We've hit 10,000 subscribers. I'm so happy and I'm so grateful for everyone's support and everyone's kind words on every single video that I post. I really am glad that you are gaining value from these videos and you have elevated your trading game using them. As I've mentioned before, if your breakthrough hasn't happened yet, it will. Keep practicing, keep studying, and eventually you will have your breakthroughs. The final thing I'm quickly going to mention before wrapping up this video are fake accounts impersonating me. As I have said before, I would never give my WhatsApp number away, and I would never get you to message me on anything else other than my Instagram, which is at Pips of Persia. This is my Instagram, okay? So make sure that if you get messages from Instagram similar to this, they might have a dot at the end, or they might have an underscore, or whatever it may be. Make sure to never give anyone your details, never give anyone your money. I would never get you to message me on WhatsApp. Even the accounts that might look similar to mine, make sure to click on them and see if they have my videos on there, because they probably won't. They probably wouldn't have the subscribers either. Long story short, be careful. In this industry, you always got to double check before giving anyone your details or anyone your money. And I would definitely never ask you to message me on WhatsApp or anything other than my Instagram, which is Pips of Persia. But with that being said, that's the end of today's video. I hope you gained value. See you all this weekend with another video. Let's elevate and let's catch some pips.